up, it's time to testify. Chain and signatures launched, we're reaching for the sky. Blockchain gets unlocked, N's leading the drive. Now sign ain't changed, the future's is live. Chain signatures we ride, anytime, anywhere. Me, I pull the code now.
Okay, welcome. We have a special episode where we have an AMA with Sam from Frax Finance, and I'm sure we're going to go into a few different directions, but specifically diving into crypto economics and how to think about tokens, their value accrual, digital commodities, and how all of this works. And I'm sure we'll touch more on some of the other interesting topics. Sam, quick shout out from you, and then we can dive in.
Yeah, thanks for having me, Ilya. For people who don't know about Frax, we call it the decentralized central bank of crypto. We're a stablecoin issuer and LSD issuer, asset issuer, and then also recently launched Fraxtal, our high performance modular L2, and we are really good at designing mechanisms, token economics, and basically right now actually is a great time to talk about this topic because everyone's talking about meme coins, tokenomic designs, what the difference is between L1, L2s, what are L1s really supposed to be valued as? Are they parasitic? How do you value near AI, Solana, and all these things? And it's I think the most interesting topic in crypto, right? As prices are mostly going up and some more than others, we'll likely see which ones outperform if we have a good understanding of these assets.
All right, so maybe I kind of we scheduled this because of your tweet around effectively like, hey, you should not think about discounted cash flow when you are evaluating layer one assets. You really should be thinking as a digital commodity and kind of looking through that lens, right? There's like a few different routes. So maybe just start kind of, outline that thesis, and let's kind of spar a little bit around that. And then we can go and kind of apply it to a few different places, like meme coins and other things. XRP is clearly,
Well, XRP is definitely a lot of things, especially recently. Sure. It's actually, I put it out in a tweet thread, and I think it got a lot of talk. And actually, Vitalik actually talked to me a little bit about it on Signal about how to think about ETH, the asset, because it's actually that was actually my motivation. My view about this stuff is that there's only two types of assets in crypto. It's very simple. There's digital commodities like Bitcoin, like L1 tokens that are called sovereign commodities. And then there's everything else that is going to be valued at discounted cash flow. I call it DCF coins, right? Discounted cash flow, future valuation of how to value all of the cash flow that's coming. And the difference between these two assets is one is structurally a digital commodity like gold, and it never makes sense to talk about any kind of cash flow, right? Like if you think about it, the Bitcoin network, the BTC holders get zero cash flow, no burns, nothing. They never have any expectation of anything from the Bitcoin network. It's just structurally different, and then it doesn't make any coherent sense. It's not in the Overton window, so to speak, right? The acceptable discourse of how to even talk about the asset, about like fees, or like, hey, when do Bitcoin BTC holders get like part of the fees from the from the transactions? No, they just all go to miners. Miners are like workers; they're not the shareholders, right? And so you can think about structurally crypto tokens as just two different things. Either they represent something like a digital commodity, or they represent what I call like labor, right? Like the labor that goes into building a product, right? Whether it's a DeFi protocol, whether it's a stable coin, whether it's a like some ecosystem lending protocol, AMM, and then the token represents that product, right? And the value, mostly fees, but value you can get for building that product. It literally represents labor, right? So like DCF coins are, I call them PE DCF coins, right? Price to earnings, discounted cash flow coins, is that those will always be valued by people. The predominant discussion around them is how to actually value, like model the discounted cash flow equation, right? And then my contention, actually, in the thread, my motivation was two things. One is making sure that Ethereum is not improperly valued as a PE DCF coin, because I think that that's been the biggest mistake in Ethereum valuation the past 2-3 years. And then two, giving a guide, or like essentially like a scientific thesis of how to turn a token into one or the other in terms of mechanism design and like social engineering, because at the end of the day, all of these things are social, right? Money is social, right? They're just, cash is pictures of dead presidents. The only reason they do anything is because we socially agree that, handing them around actually does something. So my main motivation was, how do you actually provide a guidebook for people? And actually the reason is Frax also is actually coming up with their own tokenomic revamp with the FXS Frax share token. It's getting renamed to just Frax. It's actually being announced later in December, and it's actually going to be more like a sovereign commodity. So I had to think about all this stuff and see how it applied. Actually, I was looking at Near and Solana and Ethereum and everything to know exactly how these things should work. And a lot of blockchains are a little bit better than others in terms of this system. And my whole thesis is that essentially, if you're in the PE DCF bucket, right, your token represents a product. And if you're in the digital commodity bucket, right, and a lot of people mistake digital commodity for like monetary premium. And then like, because the word monetary premium is really, really loose. It just means anything. Oh, like store it as a store of value, use it or spend it or settle it. And then it gets really confusing. But digital commodity, right? Digital gold, digital silver, like just like that actually is very clear, because like it means that there is no coherent way to talk about cash flows, right? If you think of real gold, even if there were industrial use cases of gold that somehow changed its like molecular makeup, like the alchemy of like gold, like someone figured out a way to use gold and then it changed it to like lead, right? Like reverse alchemy. People wouldn't say, oh, well, that's the dividend, right, rate of like gold, right? Even though EIP 1559, for people listening, ETH gets burned every block from the base fees. That doesn't mean it should be, thought of as a equity-like token, right? It doesn't mean those should be thought of as like dividends. It's one kind of digital use case of Ethereum. It happens to digitally take it out of circulation, but it doesn't actually mean that Ethereum should actually be thought of as anything different than Bitcoin. In fact, Near as well. Near, I think, is actually one of the most interesting assets, because I'm actually extremely, extremely bullish, as you know, on your guys' unique AI thesis and as digital AI commodity money. And like the thing with like Near is it's actually like a very special kind of commodity if it can become this like AI digital gold, essentially, as well as all the utility that it actually has. And the most important thing is to not have the Overton window, right? The acceptable course of structural discussion socially be dividends and cash flow for sovereign assets like Near, like Bitcoin, like Ethereum, like Solana. There's obviously things like Uni token from Uniswap, right? Like this is like it represents kind of like even equity in the Uniswap DAO or the AMM and things like that. And everyone's like, when fee switch, right? But no one even thinks coherently about Bitcoin like that, right? And that's what's most important.
Yeah, so I mean, obviously, we agree a lot on how this works, and but maybe just for the audience, let's kind of decompose it a little bit, right? I think one of the big like conflicting thoughts is, because indeed money is such a wide term, right, that captures a lot of things. People generally default to money, to like dollars, right, euro kind of. some of the default current like fiat currencies. And the thing is, like, those currencies are designed in a very different way, right, than what we're trying to achieve here, because they're designed to be a unit of exchange. They're not designed to be kind of indeed this digital commodity of the ecosystem and kind of the productive work that's done there. And so because of that, the supply of usually fiat currencies, right, is fluctuating depending on the needs of the country. And I think that's, to me, that's was like one of the things where people throw, oh, like this is digital money, etc. Like that's been one of the things where, like, actually, if you decompose what money means, right, it can mean unit of exchange, unit of account, it can have store of value. So like there's different functions that we assign to money, and then different assets like commodity, like gold, digital commodity like Bitcoin, can play different functions as well in different roles, right? And so I think that is like a very to me at least, be an important distinction when kind of analyzing like what this asset, like what role this asset needs to play at what time. And so I think like digital commodities is a really good way to lend it, because you say, hey, nobody thinks of like, hey, how much gold was burned right this year. Like that's not that's not a thing that and there is industrial use cases, there is jewelry use cases, there's all kinds of ways people are using gold, as well as just storing it, because they believe, like, either believe of its future value, or they use it as an alternative to whatever world events, etc. And so kind of applying the same principles here is like, and this was your examples, right? Like, if even if we burn some of this asset, it doesn't mean that like there's other use cases. And I think really important part is the DeFi itself is one of the biggest industrial use cases, and the reasons actually for Ethereum's value appreciation kind of in DeFi summer last year, few years ago, because it's effectively was sucking in so much ETH into this DeFi pools. And as assets were increasing in price, you needed to have, equal amount of ETH in that pool. And so it kind of created this natural demand. And that wasn't about burning, right? It was actually, it was providing liquidity. It was sitting there, but it was creating this like massive demand for this asset. And so from like value perspective, like, stock flow on effectively other assets launching with Ethereum as liquidity. And I think like that's kind of a good model. And I think Solana right now is showing this with meme coins, right? Because there's like 20,000 meme coins launched. You need to have, a bunch of Sol in the pool. That kind of social contract of using Sol as like main pair creates this kind of massive ramp up on the use case for Solana, right? And obviously, there's all these other use cases like transaction fees and storage, and what for staking itself is also a use case because it kind of syncs token as well. But all of that together is creating this kind of multi-industry use cases of the asset.
Yeah, and that's a really good point. And I actually, as you were saying everything there's three things I wanted to highlight. And from the top, the first thing you said was very interesting, in that national currencies are indeed totally different from money in terms of like Bitcoin money, right? Like national currencies are supposed to be pegged to a standard of living. So like most people don't really think about the dollar like this, but the dollar is a stable coin, right? It's pegged to the CPI plus 2.5% target of inflation. So people spend it rather than just hoard it, right? So like it has a peg, and the peg is a basket of consumer items. So it's meant to actually keep your standard of living like the same, right? You're supposed to be able to buy the same amount of medical care, shelter, food, oil, all of this stuff, rent, that the dollar is pegged to, right? And so that's actually the main big difference, is like in BTC or like hard commodity, like digital commodities, like they're not the same as a currency. Currency is meant to keep your standard of living the same. And in investment, on the other hand, which everyone says invest in Bitcoin, invest in Near, invest in like Frax and stuff like that. What that means is if it's a good investment, it should actually increase your standard of living, right? That's the definition essentially of an investment. So you should be able to trade it in for more currency, which is an abstraction for standard of living, right? And actually it was our kind of research in this that Frax actually issued the first CPI pegged currency. It's called the Frax Price Index, FPI. And so we've thought a lot about this because our experiments in this area and like novel stablecoin pegs basically led us to the fact that there's basically scarce assets, right? Like digital commodities in crypto. And then there's everything else there that is like PE/DCF flow, or everything, this third category that people sometimes conflate with Bitcoin, which is the stable currencies that are either pegged to a national unit, which is just trying to do the same thing, whether they fail or not, right? Is irrelevant. Some countries definitely fail by not being able to peg to a standard of living. But those are basically so I thought that those were really good points that you made originally about that. And so that's why I think usually I try not to say monetary premium and stuff like that, because people conflate like currency and money and store of value, and they're not the same things, neither technically nor academically and like economics and things like that, right? And so your second point was absolutely fantastic too, about very astute about the use case of these things like in ETH DeFi, and actually, like you said, early like last year and early this year, like basically 2023, 2024, the restaking craze absolutely exploded, right? The concept of restaking was created by Eigenlayer, and like billions and billions of ETH was restaked, and then new restaking protocols came. Everyone wanted to get additional points, airdrops, and incentives on ETH, and then lo and behold, ETH became $4,000, right? It almost actually got to its all-time high, and then as like the meme coin craze on Solana took off, right? And people sort of forgot about restaking, then ETH completely kind of retraced all of its gains back to like 2,200 or whatever. And then Solana exploded, and everyone started saying, oh my God, Solana's going to, flip Bitcoin, ETH, and then maybe Bitcoin or something like that. And you actually had a good point, because I actually went and looked at this. I actually went and saw how much Sol is being paired by every single meme coin that's launched on pump.fun. And literally right now on Radium alone, at least a couple percent, like 1 to 2.5% of all Sol, literally like all Sol in existence, is paired against the sum total of all of these like meme coins, right? And like that alone, that might not sound like a lot, but then in order for people to trade that much, that creates another 3 to 4 or 5% demand of people buying Sol to participate in all of this liquidity. And that alone, like the Eigenlayer and restaking thing, was the crazy utility and use case of the digital commodity of Solana, right, and of Sol, and ETH was for restaking. And they're kind of like digital industrial use cases, as you said really, really well, that it's really important to actually see that these things do coincide with like use cases. They literally track causally to them. It's not, it has way less to do with cash flow, right? And like some people show charts, oh my God, look, the like Solana fees are like going up at the same time, obviously, as like everyone's trading meme coins, but the PNE of like Sol is like absolutely like ridiculous if it actually was valued at PNE, right? And discounted cash flow. And it's much clearer that it's valued as a digital commodity that has a very high demand flow of industrial use cases, right? And I think the most interesting question really to as a result is, how do we actually create assets that are like digital commodities and don't get like mistaken for PE DCF cash flow, which is kind of what I was trying to write in my writings and tweet and stuff. Because if ETH can sort of mistakenly be, over the number of years, be more and more talked about as a DCF coin, right? Because everyone's talking about EIP 1559 and stuff, and less like Bitcoin. can you turn a token the other direction? Can you turn a token that everyone talks about, PE, DCF, cash flow, and can you actually change its mechanics so that everyone thinks of it more like Bitcoin, right? Because you could apparently go the other way, right? Like that's what people have accidentally seemed to be doing with Ethereum, where the first 10 years or 8 years, it was like silver to Bitcoin's gold. People even said that, right? People probably remember everyone saying digital oil, digital silver, and now it's all cash flow. How much is burned? Should we increase the blobs, increase like dividends to ETH holders and stuff? Like, let's model the PNE DCF of like the EIP 1559 burns. Should we optimize that or this or? And so it's becoming more like, should we optimize the company, right? Cash flows of the organization or something like that, rather than the way to think about it, like, you know, things like Bitcoin and you know, other assets that have actually done this well. There's also one last thing, is there's also this prevailing view that only Bitcoin can do this, and like this Bitcoin has this like anointed you know, thing of like, you're saying you're going to be a better Bitcoin, no one's going to buy it, this is BS, show us how much fees or revenue you're making or something. I don't buy that at all. I don't think these things are binary. Like, you can be a digital commodity that's not trying to be digital gold. There's many digital commodities in real life as well, right? Like I was saying, there's silver, oil, like magnesium, palladium, you know, all of this stuff, right? And obviously those are metaphors, but the point is, it's not binary, right? And so like, if you actually have a proper way of designing a digital asset and you create the right Overton window, boundaries of where you should actually have acceptable discourse, right? If the mechanism doesn't even allow certain types of coherent discussion of how to dividend fees or something like that, then that's actually how you can turn a previous kind of governance token into a sovereign asset. So
yeah, I mean, I think so. There's two parts here. I think one, is this Bitcoin and everything else, or there's like indeed different types of digital commodity assets? I think where Bitcoin has obviously a huge leg up is kind of in the meme value, right, in attention value. And kind of the way I usually look at any asset, right, is a combination of meme value, utility value, so like use case, moneyness value, and which is like, are people willing to accept this effectively as collateral, as pay, like as some form of like money, and then the governance value, which is by holding this asset, am I able to, you know, benefit in the future, right? So from some decision making. And like, to me, it's always like this combination, right? And different assets have different weights on this thing, and indeed you can talk about it differently depending how you look at it. But, you know, Nvidia, for example, is, you know, purely utility, right? Nobody's using like Nvidia for moneyness. There is governance value, but it's also like, you know, Jensen's running that like a tight ship. But the multiple to their revenue is clearly showing this is a, you know, because the attention and mean value is so high, they have way higher multiple on their revenue. And so that's kind of what kind of like, it's important to understand that the attention translates into massive multiples. And also, you know, like the more liquid asset itself is being, the easier it is for people to build positions, and then you have a better like stock flow, etc. So I think the examples here, that's good, because I was actually just reading the XRP thread, right, where XRP is effectively used as what should be used, the stable coin, because like people, like what Bridge was doing, right? You come in from, you know, one country, you exchange to XRP, you move to another bank, and that bank exchanges back to the local currency. And you know, because this works so fast, they're okay with, you know, some volatility on XRP. But what this creates is massive volume, right? Because like, if nothing else, it just creates a ton of volume around the world, and now you have a ton of market makers, you have a ton of kind of participants in the network, and that creates obviously like opportunity for people to come in and really you know, build positions and kind of move the market as well when there's not enough supply. And so to me, those are interesting kind of aspects of this as well. And it's true. I think commodity market is very similar, right? Depending on kind of how liquid the market is, how good the futures actually market is. Like people use it, like people use the futures market sometimes as a way to build like really interesting instruments, even if they don't really care about the underlying, right? Like, you know, the futures on whatever corn, really good like weather prediction or something like this. So yeah, so I think there's a lot of interesting things where the DCF model just kind of you know can be a part of the use case from perspective of again either the governance component or the one of the use cases of utility, but it kind of really misses on, for example, I mean this is actually the purest example is, you know, let's imagine, Sam, we decide to launch a new layer one, right? And, you know, we launch it with a new token. We say, hey, everybody should stake, you know, to validate the network. That right away creates some demand on the token. That right away creates, like, even though the network doesn't do anything yet, we just created effectively already a use case for this asset. And that itself creates value, right? And so I think that those are, and depending on how much attention effectively we can create around this thing, how much people excited about it, that will kind of put it at different positions on that multiple of over the use case of the staking. So I think that those are interesting ways to kind of think about, like, to me, those components, how they work together sometimes, and how for different assets they kind of in the different buckets. So that's why, like, I don't think DCF on itself is bad. It's just like you cannot use that to evaluate the market cap, because there's all these other components that will come together to actually construct it.
Yeah, I think that's really well said. I don't think DCF is bad either. However, there's one thing that, like, if you actually use the DCF model, right, the pricing power is bidirectional, right? It doesn't just add actual like market cap to a token. So otherwise everyone would try to add everything, right? Like into like the model of how to value something. The danger is, if everyone is using, like, or most people are using PE DCF flow, right, then they're going to say, hey, this is overvalued. Why the heck is, like, you know, Ethereum with $3 billion of burns, like worth, you know, $400 billion, while Apple with $400 billion of annual like revenue is only worth like 9x more than Ethereum with over like 400 x or something of or 100x of like revenue, right? That's like two orders of magnitude off, and so people will like short it, right? And so it's a lot of things about creating this Overton window of like what is the acceptable structural discourse and what makes sense. And you actually said something great about NVIDIA or like stocks in general. Is I actually believe, like, if it wasn't for the securities laws, which are good, I'm not saying anything bad about them, but the traditional financial custodial laws and securities laws, it's actually totally possible and likely that equities would be actually at least even thought about of maybe being used like within the App Store. Maybe you could buy literally like Apple iPhone apps with Apple stock. And like, this is like one thing that people thought would happen with like the original ICO tokens and stuff. But the reason that never took off was the tokens were like not liquid and big enough. But you see this happening with ETH and Bitcoin and really big stuff like Near and Solana, clearly, right? Like they do buy stuff with Sol, ETH, BTC a little bit now. And if the custodial laws were not so that like literally you can't hold the stock in a non-custodial manner, you hold it through a series of chains of custodians, they don't transfer it for 2 days later. So the only thing you can do is invest in them or like sell them, right? So the only thing you can do is value them as PEDCF. In fact, the SEC goes out of their way in like whenever the meme stock frenzy or something happens, right? They like put out a, you know, like a disclaimer, or they like go to the company and say like, you know, put out a press release, say like, this is, you don't understand why the price is like this, to discourage any type of pricing function other than PEDCF, because they basically, their goal is to make markets orderly, which means to actually make sure that equities are like valued as PEDCF. If anyone tries to actually, and structurally they've created a financial system that discourages, not to the letter of the law, right? Like it's not illegal to exchange Apple stock for like something like a car or like a computer or something, but it's structurally impossible because it's have multiple custodians, brokerage, the US trust company, the DTCC or whatever it's called, that holds all the actual physical stock certificates and then the digital representations of them, right? And so it's literally impossible to use equities as like anything other than PEDCF, right? And in traditional finance, crypto is the first time you could actually have these two things that have both PEDCF valuation and like monetary commodity industrial use cases be used in a digital way. And that's why it's confusing for a lot of people, because they're not used to, like they're like trained mentally, right, for generations, right, to think about, okay, is this PEDCF? Like, is it a stock? Is this not PEDCF? Is it a commodity or like some kind of currency, money or something like that? And in fact, I think that the meme coin craze actually proves my theory kind of correct, because I was talking to Murad, who's a big meme coin thesis guy, and he actually I think thinks about things the same way, because meme coins are like the embodiment of Bitcoin. It's like fair launch. There's a fixed supply. There's no way to actually increase it. There is no governance of anything, because it's literally by definition the token is the product. There is no product. That the token is the meme is the product, right? And so the fact that they can have cumulatively billions, maybe now tens of billions at least, because things like with dog with hat and all these things probably in the tens of billions now in total. The fact that they can have that market cap proves that it's not just Bitcoin. It's not just Bitcoin and Dogecoin as the only other fluke, right? And that actually, I think, proves the thesis correct, is you can create digital commodities. You have to do it right. And so I think my personal view is there's two important things. One is you have to not necessarily have no emissions or like some kind of like stop, but you have to have a clear fixed emission equation, whatever that is. Like even Bitcoin right now, everyone knows it's 21 million, but it's not 21 million until 100 years from now. 2142 is like the exact year. That's fine. That's good. That's how it works, right? You have to have a fixed emission schedule, and you have to change the Overton window, where it doesn't structurally make sense to actually talk about the burns or anything like that as anything other than industrial use cases on chain. And that's my view on it, at least.
Yeah, that makes sense. And again, I think actually, yeah, the examples that like we have a bunch of like pretty high valued meme coins, which to me is example of that. Like they actually don't even have industrial use case. Like nobody's somewhere like stuck in bank because they're gonna be like able to to do cross country trade, whatever, international trades through bank, right? Like which was kind of a use case for Bitcoin for a while. Is like, hey, very liquid asset, we're able to do international trades with. So it's really purely just the attention and kind of the community of people who are like, hey, this is effectively the commodity we like. This is our gold, right? We wear this on on our.
It's our jewelry. It's their jewelry.
Yeah, exactly. I mean that to me actually, Dodge and Bonk are examples of jewelry. Like these like. That's a use case effectively people have. It's like, hey, I'm part of this community. This is how I associate, and and you can have multiple. Like it's not this. The other thing is not exclusive, right? You cannot like, oh, I only wear gold, I never wear silver, right? No, it's like you can have multiple different, jewelry kind of, which made of different thing. But yeah, like this is jewelry of the modern age.
Yeah, I mean that's actually that could be a meme itself, right? Like Doge is digital jewelry. Doge is the swag, right? Dog with hat. That's actually a good way to put it, especially because usually jewelry is made from digital commodities, right? Like gold and all these things. And in fact, you need Sol to generate digital jewelry on pump.fun, because you need to actually pair it with SOL as the liquidity, which makes a lot of sense, right? It's actually see the parallel of like, you need to use this commodity to generate digital jewelry that has a use case. And I think that's the really cool way to put it. And the idea is like, what I think is important is, as long as there is a fixed immutable emission equation and an easy way to communicate the actual like total supply, whether that is right now or not, right? Like, as long as you can communicate it so that the Overton window is very clear, like, hey, this is just, I can describe this asset in one sentence, right? 21 million Bitcoin, or like, even if it's just like 1 million tokens get printed every year forever. Like, even though like that actually it's like decreasing emissions, but it's forever. Actually, that's what Dogecoin is. I believe it's like 10 billion Doge a year or something like that. And that's fine. And then you can actually, even one thing we're thinking of with FXS, the Frax share token that we're about to announce, the relaunch of this new ticker that's just Frax and much cleaner, and you can validate things on Fraxtal, and the AI functionality that we've been talking about a little bit between each other is like, if you can actually fix the emission, but you actually make it so that the actual tail emissions go to some kind of contract, right? Like a tail emissions system contract on the chain. And then you actually are able to allocate those tail emissions in a more versatile way. And that could be where the governance power is, but there can never be any actual tail emission change to the token unless there's like a hard fork of the network, which is the same thing with Bitcoin, right? And in theory, like Bitcoin can change 21 million if there was a hard fork, but it's so socially contentious, it'll never work, right? So what you do is you ossify the most important property you need to ossify, which is like, this tail emission can never be changed. Otherwise, the entire social contract is like broken, and you can like point to the tail emission like equation, the one that actually computes to the full max supply. And then from that, you can actually program modules like, does it go to validator security? Does it go to like AI inference validators? Does it go to like DeFi growth, like economic growth or something like that? But nothing can ever change this tail emissions. And then if you do want to do burns, right, like things like EIP 1559, you actually make it clear that these burns are actually not dividends, right? They're basically industrial use cases of the infrastructure, right? Now people finally understand EIP 1559 is kind of like burning digital oil, but the issue is it has 2 years plus of Ethereum narrative of like, this is a dividend that has to be undone, right? But if you have a new community that's better understanding of this, you can have things like top level like domains that you need to buy that like .near, .frax, stuff like that permanently burn stuff, right? Those are just like infrastructural things. Base fees that are just infrastructural things for how the chain actually needs to run, right? Other things that are devised over a number of years, and those get burned, and those go strictly into this like immutable burn like system equation, where whenever these assets go here, they just get burned forever, and you can't change that either unless you actually go through a hard fork. And that's actually like, I think the most important way, the simplicity of just being able to socially enshrine these things and then just let people coordinate and ossify the most important social like factors of an asset, while being able to be versatile with governance of the like tail emissions to a certain degree. That is how you maximize the actual value of the digital commodity.
Yeah, so this is actually exactly what we've been looking at with House of Stake, is to effectively build that governance of tail. So Near from the start had part of tail emission going to effectively the treasury account that, I mean, up to now has not been used at all, and so, but has this kind of perpetuity emission in it, and so kind of we're working with Gauntlet on the design of this House of Stake system, which is indeed like token holders, stakeholders, staking representatives are able to decide on where to allocate these emissions, which indeed can be DeFi growth, or maybe sponsoring more validators, or doing these things. And so I agree that is like it's a way better programmatic approach versus at Genesis trying to predefine and who will receive what, and then hoping that like one of the challenges that we were trying to fix is that like there was no continuous budget for continuous development of the protocol, and obviously growth and other things. And so like how do you you do need some form of that. And again, there's nothing wrong with a new digital asset created, right? Like it's the same as commodities being mined all the time. Like we don't expect gold to like, yes, there's some amount per year and like maybe it fluctuates, but we don't expect that to run out. But I think there is need for kind of supporting the ecosystem and technology and everything which can be used through this mechanism. But maybe to turn around the question, kind of you're postulating a very clear statement, which is like, hey, effectively the tail inflation kind of formula should be fixed. And so I'm actually curious, because this is something we've been discussing as well across the ecosystem, because we haven't really designed that very, initially when we launched Near. Right now, it's a good time to like, hey, this is how we want it to be for next 100,000 years. But obviously, even the fact that you want to change it now is kind of introducing this idea that this is changeable. So I'm curious kind of how you think about that. Like how should people approach this kind of things?
Yeah, so I think like that's a very, very well said in terms of, actually, I think the reason Near is such a great asset is like you guys currently work exactly the right way of this. Emissions goes to one place, and then this separation of concerns, right? Like the most important thing to like create it as immutable is the equation, right? It doesn't matter as much. People used to confusingly think, oh, both the location and the emission needs to be like fixed permanently, and then you create this situation where there's no way, no one can predict the future in terms of all the different places that you want to actually spend this digital commodity, right? Like spend, like you said, the gold that's mined out, right? But if you're going to program a sovereign asset that has a very, very solid immutable social contract, what you have to do is you have to actually fix the emission, but you don't need to fix the exact place where it's going to go 100 years, like over the next like 10, 20, 30, 100 years, right? And that's what's really important, is like, I think that's basically what Bitcoin got right. I think that's what Dogecoin got right, because the equation is very simple, like, right? And if I ask you right now, how much, what's the supply of Ethereum going to be in 2030? I couldn't tell you. I know it's like right now it's 120 million something, but I don't know in 2030 if it's going to be like, and forget the burns, pretend there's no burn. We could just add the burns later, but just how much is the tail emission? I actually don't know, because it's actually very difficult. It's like called minimum viable issuance. And I actually don't know what it is off the top of my head. And I feel like I'm a pretty technical person myself, like in terms of like trying to keep up with everything. But that's what's important, is a simple emission equation that can be ossified socially, right? And then if there's going to be burns in infrastructure, things like base fees and like infrastructural industrial use cases, they get immutably put into this system burn contract. And you can actually, we were experimenting this very interesting way of like, if emissions slow down, right? Like if every year they go down by 10%, or they have, or something like that, the burns from like the token, from the burn engine, right? The contract, they can programmatically, because the burn engine is fixed too, right? They can go the other direction. So they go into the emissions system contract. So for example, as the actual raw emissions like slowly go down, the tokens going into the burn contract that get burned, less of those get fully burned, and then some of them get sent to the emission contract as the actual real emissions go down, so that you always have this security budget, right? One of the main biggest issues with like Bitcoin that people currently bring up, it's too early to know, but is the security budget, right? If you have every 4 years, and if Bitcoin is not doubling in price at least every 4 years, so far it's looking way more than doubling every 4 years at least. But the idea is like, if the purchasing power parity of BTC doesn't double every 4 years, then Bitcoin loses security as a trade-off, right? And that seems kind of bad, right? Like that's not part of the design. And so the reason like Ethereum has like this fixed minimum viable issuance forever, that makes it a little bit difficult to understand how much the actual supply currently is or will be, is that they don't want that security budget issue to be part of the Overton window of like legitimate discussion. Well, one way you can do that is you could still have a fixed supply that kind of tapers off, right, to like a clear number at a clear year, but you have this burn system that tapers up. So like at that like year, as the burns actually go, more of them get sent to the emission contract, and then the actual emissions that hit the max supply and the emissions go to zero, there's still security budget funding. So there's this concept of like this smooth like regression in both sides, where like if you can increase the industrial use case of the digital commodity over the lifetime of emissions that it's like mined or like emitted or things like that, then you create a sustainable economy by combining the two equations. Like that's one of the kind of modeling and research that we're doing, that when we announced the FXS revamp, right, actually very close, like in the next 2 weeks, we'll show what we've come up with.
I mean, I think because like Bitcoin also has, I mean, effectively the transaction fees that are going to miners. So, I mean, there's some other like more technical problems around like selfish mining and rewards, etc., that comes when you don't have block rewards. But I mean, kind of what you're describing is not that different from kind of, idea that Bitcoin inflation tapers off, and, presumably just transaction fees will be the ones covering the security budget. I mean, we've taken a little bit different approach, yeah, where and there's an interesting kind of also perspective, like burning fees, but then effectively you're reminting back what was burned. And there's like an interesting thing about like burning fees, you kind of disconnect the source of funds from like kind of tracing perspective, and like newly minted, even though it's effectively the same math, right? Newly minted are coming in like, from clean address, from system address. But I think, I mean, there is something about like, I agree that something about like a simplicity of the function kind of gives such a powerful story to tell, versus, and where if you position it as digital commodity, indeed, like it's just an easier way to think about, like you want an easy way to think about supply, and then kind of how it's going to be used. And so in that case, actually, yeah, like you don't even need to burn anything now. You can just like stash it into some pool, because like it just locks there. Like effectively, it's the same thing. Like I mean, there was a joke on Twitter before where I mean, you can give homeless person $100, so you can burn $100, and homeless person got more value from that, as everybody else, right? So, but like in the same kind of spirit, yeah, like burning is effectively doesn't really change the economics, and I think that's been clear for Ethereum, where even though it was negative deflation, the price was still going down, which like economically, if it's a deflationary asset, you wouldn't sell it, right? Just like economically, that should be the approach, right? If you are thinking of this as just purely deflationary asset, which it was not.
Actually, I'll let you take an even more hardline stance on it, where it's like, not only does it not increase the value, it actually decreases the value. I'll even go further, and because remember, in terms of what my main concern is like, if you can talk about dividends from an asset, you actually get everyone to start modeling it as like a DCF cash flow asset. And like, for example, when you look at the ETF traditional financial people, right, and they're trying to sell their BTC and ETH ETFs, right? They don't talk about cash flow for the BTC ETF because Bitcoin makes no sense. But then they all educate all of the older generation of people on DCF, like, oh, Ethereum is like a digital business, like a global computer, and it burns like things. Here's how much revenue it's made. And then like people will say, oh, this thing is overvalued. Like, why is this worth $400 billion if it's only made 4 billion the prior week? I'm not going to buy it. But oh, Bitcoin might get bought by like the Fed and like the new Trump administration. Let me go buy that, because that's the story, right? And you said it really well yourself, which is like the easy to communicate like social equation of like the fixed supply or the fixed emissions is a way for people to coordinate on a ossified social contract, right? You can't ossify a social contract that people can't clearly describe, right? Because like that's the main thing, is like you need everyone to coordinate on something that they all understand. And even the slight difficult thing to understand, some people get mentally priced out essentially of coordinating in this direction. So
Yeah, that's a good point. Well, I mean, there's a lot of topics here. We covered some of them as we're approaching end of the hour. Anything that I mean, you guys obviously are shipping a lot of stuff and announcing things. So anything you want to kind of close up that Frax is doing that people should know?
Yeah, I mean, well, we're extremely excited about collaborating with Near AI and everything that we've talked about, and also getting Frax assets even more used in Near DeFi. And we're going to actually announce in this roadmap that I was referring to, both the FXS revamp of it being a sovereign commodity, but tons of other things where we're going to issue Frax USD natively mint redeemable on Near, obviously, and other kind of yield bearing places that people can enjoy this asset on Near. And then more long term, the most important thing I think that I'm extremely excited that we've talked about is how to team up in sovereign AI, actual on-chain stateful AI agents that are tokenized and co-ownable, because this actually goes really, really well into what we were just talking about with PE DCF versus commodities. Is like, as AI gets better and better, their AI tokens, essentially the real AI tokens, not meme coins, but real AI tokens that let you co-own a growing and useful and trained stateful sovereign AI agent, are going to be the most valuable PE DCF, the discounted cash flow tokens, because they're the ones doing all of the work, right? Like, they're the ones that are going to be doing all of the trading and things like that. And the other non-AI tokens are going to be digital commodities that do really well, right? Because those are the only things that in the end actually have, in a post kind of AI world, have economic value because of their scarcity and their social coordination and their use case, their industrial use cases, right? Because PE DCF essentially is going to be abstracted to AI, right? Because AI is going to be doing the work for like pretty much everything. And I think the cash flow tokens will eventually just represent a certain AI agent. That's actually my long-term view on this, is like we've talked about, where I think the best like value to value AI agents will be eventually the sovereignty of the agent, like how sovereign is it actually, what the token represents, and then DCF of the token, how much the actual AI agent can earn over the plethora of things that it's actually doing. I don't think, earning a few bips traditionally on like fees or something like that from a smart contract is going to be the winning valuation metric for tokens. It's going to be AI, and it's going to be sovereign digital assets. And that's what we're actually super excited to deeply collaborate on, like in a real manner with Near AI. So I'll end it there.
Yeah, no, totally agree. And I in general think AI is effectively the last tech wave. And so effectively everything where we care about the outcome, not the process, will be automated. That's like, just, you care about how, musician plays music. not about the outcome, right? So like there you care about how people play sports, but anywhere where you care about the outcome, right, will be automated.
Yeah,
and so
totally.
I mean, over time, and like, but especially for anything that's digital and like digital first. And so I agree that a lot of this kind of will be done by agents. And so yes, autonomous agents effectively is autonomous corporation that can have token holders that are benefiting from this corporation operations. But it's provable, verifiable, private, etc., with all these properties, and that will be representing a DCF. And then everything else is kind of is more of a digital commodity that these agents are going to be using themselves to interact with the world.
Yeah, I think the most interesting concept to end out with, we've been talking about digital commodities, is I think the most likely thing to be AI digital money. Maybe it's Bitcoin. I think Near is very, very likely to be the one. And like, we have our own view on how to structure things like to make it AI commodity money, but I actually think that has the highest market cap potential of anything after Bitcoin, digital gold itself. So it's going to be an exciting year.
I agree. All right. Well, thank you for coming. I hope it was informative for folks, kind of expanding on your thesis and how we're thinking about this. And I'm sure we'll do more of these things. Thank you.
Thanks, Ilya.